Hello, good day. So, our topic for today is partnership operation. So, meaning the partnership is now making business and earning profit or having losses from the operation. So, our learning objective is to identify the modes of profit and loss distribution of the partners, to learn how to compute for the distribution of the partnership profit. So, let's take a jump. And so what is divisions of profit? So usually division of profit can be made equally divided, meaning 50-50 among each and every partners. Next, we also have a distribution on arbitrary ratio, meaning you wherein you could dictate what ratio, 20-30 or 3 is to 2 is to 1, something like that. We also have this on distributed on capital contribution. So distributed in capital contribution, it could be at the original capital balances, the beginning of the year, the end of the year, the average capital balance of the partner, or a simple average of the partnership capital. Then we also have distribution of interest on partners' capital. Balance is being agreed ratio or it could be arbitrary. Next, we also have provision for salaries to partner. Sometimes this is applicable to industrial partner. And then we also have provision for both salaries and interest, which also include bonuses to partners. Okay? So let's. Article 1797 of the Philippine Law on Partnership state that in the absence of any stipulation of profit and losses shall generally be divided in proportion of to the partner's respective contribution. So meaning if in the article of partnership there is no stipulation as to profit and loss, as a general rule, it should be divided into the partnership capital because this would now be just and equitable among the partner. Okay? But normally it was stated in the absence of loss, in the absence of a stipulation for loss, and there is a stipulation for the profit, loss follow also in the profit distribution. Next, as a general rule, profit and loss shall be distributed in conformity with the stipulation in the agreements such that they agreed upon in the article of partnership if applicable. In case the partner agreed merely on the share distribution of the profit, it is understood that loss shall be the same proportion. See, is what I am saying you. In the absence that there is no stipulation for the losses, but there's a stipulation for the profit, then the losses will follow the distribution of the profit. Okay, but take note, since partnership is a mere agreement, it's like a contract and obligation. The stipulation of the party would always be the number one priority. In the absence of stipulation, we follow the law, which is the distribution of profit would now be divided into the proportion of their respective contribution. Okay? So example, partners Carr and Kevin of KKR Academy with the capital balance are shown below, having a net income of 36,000. So let's first check their capital balances. So Carr's capital, initial investment is 50,000, then additional investment on April 1, 2020, 60,000, giving her a balance of 110,000. While Kevin, initial capital contribution is 70,000, additional contribution on March 1, 2020, 60,000, and October 31, 2020, 75,000. So giving him a balance of 205,000. But guys, always check on the dates because sometimes at the average capital, if it's based on the average capital, the period would matter. So sometimes the examiner would give you a different view so that you would be able to what? You would be able not to, because sometimes we were so engrossed that it was always the initial contribution would always be on 1, and for the 75 it's on 31. So sometimes we would compute for the entire month. So be careful with the dates, okay? So question, decide to profit to divide the profit accordingly. So different cases. So case 1, profit and loss are divided equally. So if it's equally, we don't have any so much problem with that one. We just divide it by 2. Then the profit and losses are divided in arbitrary ratio of 3:2. And then profit and loss are divided into the ratio of capital of partners. Okay, so let's answer. So case 1, profit and losses are divided equally. Net income 36,000. So let's see. So meaning it's 50-50 for Car and Kevin. Therefore, there will be having 18,000 each. So 50% of 36 is 18,000. So 18,000 for Car, 18,000 for Kevin. So our entry would be debit income summary account, net income 36,000, because take note this is a sundry entry or our temporary entry for all our revenue and expenses or the nominal account. Then we credit Car capital 18,000 and Kevin capital 18,000. So next, case 2, profit and loss are divided in arbitrary ratio of 3:2. Net income still 36,000. So we could convert this into percentage, which is 60/40, or we just simply divide 36,000 by 5 and multiply it by 3 and 2. So for this one, I use the percentage. So Car received 60% of 36,000, 21,600, and Kevin received 40% of 36,000, 18,400, or 36,000. Or we could just simply divide 36 divided 5 and then multiply it by 3 to Car and multiply it by 2 to Kevin. So entry would now be debit income summary account, net income 36,000, and then credit Car capital 21,600, and Kevin capitals 14,400. Okay, so case 3, the profit and loss are divided in the ratio of the partner's capital. So it's a partner capital. Usually it has different categories. So number 1 is the original capital, or it's also known as the initial capital. So for our example, Car would now be initial capital of 50,000 and Kevin has 70,000 as their initial investment. For number 2, capital at the beginning of each fiscal period. So usually, take note that the original capital and for the number 2, beginning of each fiscal period would almost be the same, because take note that this one is only first year of operation. But on the second year of operation, there will be difference. Why? Because take note that the capital balance is affected by withdrawals in the profit and loss that has been earned by the partnership in the partnership. Okay? So it would be different in a bit. But for the second year of business. Next, capital at the end of each fiscal period. So it's the ending capital balance. So for our example, Car has 110 and Kevin has 205,000. For on the average, we would be discussing more in details of this one, but the average would be the average, like for example, for Car, she has two investment. One is 50,000 and then additional contribution in April at 60,000, while Kevin has 70,000 initial capital, additional contribution of March 60,000 and October 31 75,000. Okay, so let's now take a look. So for example, this one, case 2 at the beginning capital. So take note, we know that the capital balance of Car is 50 and then Kevin 70, total of 120. We had to divide 36,000. So 36,000 divided 120,000 times 50 would give us 15,000. 36 divided 120 times 70 would give us 21,000. Okay? So our entry would now be net income 36,000 and then Car capital 15,000, Kevin capital 21,000. So this one I don't put any more the entries since it was just still be the same. So for the ending capital, we have the ending capital of 110 and 25. So it's just the same. We divide 36,000 divided by 315 times 110. So that's 12,571.43. 36,000 divided 315,000 times 205,000. It's 23,428.57. Okay. So take note, case 3, profit and loss are divided in the ratio of partners capital, average capital. So we check. So these are the capital balances and its contribution. So take note, for Car, you have 50,000 outstanding for 12 months. So it's January to December, so 600, and then 60,000 outstanding for 9 months. It's April, May, June, July, August, September, October, November, December. So that's 9 months. Divided by 12, 1,140,000 divided by 12. So that's 95,000. So for Kevin, we have 70,000 outstanding for 12 months. That's 840,000. And then 600,000, 60,000 times 10. That's 10 months. It's March up to December, 600. And then we have 75,000, 2 months. Take note, be careful. This is October 31, so the counting would now be November and December. Be careful with this one because most of us are comfortable using the start of the date. But since the examiner knew that, the examiner would put those that are not comfortable to us so that we should carefully read the statement and the dates. So in this one, it's October 31. So October 31, it's only two months. It's November and December. So that's 1,590,000 divided by 12. 132,500 is the average capital of Kevin. Okay, so case 3, same. You could also use this computation. So 50,000, the capital balances. So 50,000 times 3. So that's 150,000. And then for the accumulations, 50,000 plus 60,000, 110,000. That's for April, so 9 months. 990,000, so 1,140,000 divided by 12, 95,000. For Kevin, we have 70,000 times 240. 70,000 plus 60, the additional contribution in March, times 8, is 1,040,000. And then the last additional 75,000, 205,000 times 2, 410,000. So the average capital is 132,500. Okay? So let's compute. So 36,000 divided to 227,500 times 95,000. That's 15,032.96. 36,000 divided 227,500 times 132,500. Then that's 20,967.04. Okay? So take note, provision of both salaries, interest, and bonus to partners. So salaries are usually given so that to compensate the working hours of the partners. And then interests are usually given to the capital balance based on the capital so that to compensate their capital contribution. And bonus to partner are usually given if they had given something special to the partnership. So normally it has two kind before and after. We will discuss that later. So take note, partner Carr and Kevin of KKR Academy with a capital balance are shown below with a net income of 36,000. So here's the capital balance is still the same. So we have interest 8% on the average capital of the partner. Take note, we already compute for the average capital balance. And then salaries 500 and 400 per month. Guys, be careful with this one. Sometimes the usual in the book, the usually givens are in annual. So you don't have to multiply. So if it's per month, you had to multiply it by 12 because it's the earnings is for the whole year. It could be fiscal year or calendar year. So you just have to be careful with this one. Usually in the book, it's usually annual. So since we become comfortable with the annual, we neglect that. So take note, if it's per month, we multiply it by 12. If it's per quarter, we multiply it by 4. Semestral by 2. You just have to check what mode the salary is given. Okay? So next, bonus of 5% before interest and salaries to Carr. And then bonus of 5% after bonus, interest, and salaries to Kevin. And the remaining is divided on their beginning capital. So 8% on the average capital. So take note, 8%. Carr has how much? Average, 95,000. So 8% it's 76. 132,500 for Kevin times 8%. We have now 10,600. Total of 18,200. Okay, for salaries, take note, it's 500 and 400 per month to Carr and Kevin. So that's 500 times 12. We have 6,000 and 400 times 12. That's 4,800. That's 10,800. Okay? So next, bonus of 5% before interest, salaries, and bonus to Carr. So we have bonus, take note, it's before, so we just multiply it by 5%. So 36,000 times 5%, it's 1,800. So we have now 1,800 bonus to Carr. Okay? So bonus of 5% after bonus, interest, and salaries to Kevin. So we have now our formula X which is our value. So X is equals to net income less A, interest, B, salary, C, bonus to car after, before, and then D less the bonus after, bonuses, interest, and salaries to Kevin. So X is equals to 36,000 less 18,200 less 10,200 less 1/8 less the bonus that should be given to Kevin, which is we didn't know yet. So if we minus it, we would have X is equals to 5,200 less 0.05 bonus, or we just put it X so that it would be the same value with the X. So we have now X plus zero point 0 B, or X is equals to 5,2. So X is equals to, because we would divide that, X is equals to 5,200 divided 1.05. So X is now 4,952.38. We multiply it by 5%, we would be able to get 246.62. Okay? So we could recheck. We minus 36,000 less 18,200 less 10,800 less 1,800 less 247.62. We will arrive at 4,952.38 times 5%. It would just be the same. So meaning we knew that it's correct. So that's the checking purposes. So next, remainder is divided into their beginning capital. So remainder, it's a remainder, we only have remainder of 4,952.38. So we divided by 120,000 times 50,000 for car. So that would be 2,063.49, and times, we divided 4,952.38 divided 120 times 70,000. That would give us 2,888.89 to Kevin. So value would now be for the share of profit to car is 17,463.49, and to Kevin it's 18,536.51. So if we add, it's still total into our net profit, which is 36,000. Okay? So hopefully you like this video. Please help me reach out more people by hitting the subscribe and like button below. God bless you and keep safe as always. Comment below if you have questions. Bye!